Hi, I'm Nick Weber, and thanks for joining me. Let's say you were driving home from work, and on the radio you hear there is a national emergency and all of the banks will be closing for a long time and potentially indefinitely. So you decide you want to get all of your money out of the banks. The only problem is that you are an equal distance from all four of your banks, and there is only enough time to get to one of them before they close. In Bank 1, you have $45,000. In Bank 2, you have $600,000. In Bank 3, you have $1 million. And in Bank 4, you have $5,608,500. Which bank do you go to and pull your money out from? Most people would say that they would take their money from Bank 4 since it has the most money. Well, each of these bank balances represents the insurance replacement cost for a typical asset you own. The $45,000 represents the replacement of your car. The $600,000 represents the replacement of your home. The $1 million represents a typical amount of life insurance benefit that people get. And the $5,608,500 represents your lost income if you became disabled, assuming you were age 35 and making $100,000 per year until age 65, and your income were to grow at a rate of 4%. For most people who are still trying to grow their net worth, their income or ability to make money is their greatest asset. Therefore, it's my opinion that this is your most critical asset that should be insured. The goal in financial planning and to building your financial foundation is to reduce the risk and severity of as many unknowns as possible, which could derail your progress. We want to have the greatest chance at maintaining our current paths and goals. Therefore, it is critical to properly protect ourselves from any devastating financial obstacles, such as losing our greatest asset of being able to earn money. Let's say you were offered a new job and the employer gave you two options for your pay. Would you rather make $100,000 a year and potentially receive $0 if you became disabled? Or would you rather make $98,000 a year and continue to receive $60,000 a year tax-free if you became disabled? Most people would choose the second option, and I agree that this is the prudent choice. By properly addressing your disability insurance needs, option 2 could be a likely scenario for you. I find disability income to be one of the most critical foundational insurances because statistics show that 1 in 4 of today's 20-year-olds will become disabled before they retire. Because of this, it's so surprising that so few people focus on buying this insurance. Here are the reasons why most people file claims for short-term and long-term disabilities. I find these claim statistics to also be interesting because when most people think about a disability, they think of a catastrophic accident. However, very few disabilities are the result of an injury, and very typically the reason people can't work is because of illnesses like cancer and strokes instead of from injuries. So what would you do if you became too sick or injured to work? How would you pay your bills? Well, let's discuss your options for a moment to figure out how you can help protect your financial future if you were too sick or injured to work. The typical programs that can pay you if you become disabled are workers' compensation, state disability, SSI, SSDI, group disability insurance, and individual disability insurance. And it's important to note that all of these options are not created equal. Some of these programs even use the any occupation definition in being disabled, which as an example, let's say if you were a surgeon and permanently injured your hand, you could still make gainful employment as a telemarketer, and therefore you might not receive disability income payments because of the any occupation definition. Therefore, it's critical to understand these programs and which options fit your needs and wishes. First, workers' compensation insurance only covers time away from work if the disabling illness or injury was directly work-related. In 2016, only 1% of American workers missed work because of an occupational illness or injury. Therefore, I find it unlikely that this is a good solution for your disability income needs. Next, you may be eligible for your state's disability program, but these programs are not guaranteed and they vary from state to state. For example, in California, there is only a short-term disability program if you meet a certain threshold of income and you have paid into the program. If you are a W-2 employee, you should see this payment withheld under the taxes section on your pay stub and in California it is typically shown as California SDI. Since California only has a short-term disability program, it only covers insurance payments up to the first year of disability, and the payment is capped at a certain threshold, and depending on your situation, it may or may not be taxable. So, if you're eligible, it's nice to have a state-funded short-term disability option in place, and in my opinion, California's short-term disability program overall is pretty good. To learn more about this insurance, contact your state's employment department. The name of this department will vary from state to state, but again, in California it is known as EDD, which stands for the Employment Development Department. So let's assume you can receive the state's short-term disability income. But what if you were disabled for longer than 1 year? There are some federal programs that exist through Social Security, however there are some challenges with these options. The two federal programs are SSI and SSDI. SSI is a means-tested benefit, which means that you basically have to be destitute in order to receive this benefit. Also, SSI is really to help elderly and disabled persons cover their basic needs, such as food and shelter, and is hardly a real income replacement, since in 2020, the federal SSI payment for individuals was under $800 per month. SSI is an entitlement program like a welfare program and meant for disabled and elderly persons who have never worked or haven't earned enough credits to qualify for SSDI. SSDI is also an entitlement program but is available to persons who have paid into the Social Security system for at least 10 years, and they are still eligible regardless of their current income or assets. There are some exceptions to this requirement for some beneficiaries, but this is the general rule. So while this sounds pretty good, some of the problems with counting on this benefit as your disability income plan are: first, the Social Security Administration defines disability as the inability to engage in any substantial gainful activity by reason of any medically determinable physical or mental impairment which can be expected to result in death or which has lasted or can be expected to last for a continuous period of not less than 12 months. Ultimately meaning you have to be very disabled to receive a benefit, and unfortunately, the most recent study I have found shows that over the 10-year period from 2006 to 2015, only 34% of SSDI claimants had their applications approved, 23% at the initial application stage, and the remainder after a reconsideration or appeals process. This means that 1/3 of applicants were ultimately approved. And if you did receive an SSDI benefit, it may not be a good replacement of your income, since the average SSDI benefit as of January 2018 was under $1,200 a month. That equates to less than $15,000 per year. Therefore, in my opinion, I wouldn't count on the government to offer a sound solution for us regarding a long-term disability option that gets us close to covering our current paychecks. If you are interested in learning more about SSI and SSDI, then visit ssa.gov or consult with your nearest Social Security office. So what other options do we have? I would say if your employer offers you group disability benefits as part of your employment, then I typically recommend you sign up for as much coverage as you can get through your employer, since it's typically inexpensive and you can't be denied. Also, if given the option to pay for your benefits with pre-tax or post-tax dollars, I recommend using post-tax dollars, since doing so will make your benefits tax-free if they pay out. This should net you a higher monthly disability amount than if you had to pay taxes on the benefits because you paid for the insurance with pre-tax dollars. Also, if your group disability coverage only pays a taxable benefit, then I think chances are good it will not be enough coverage, and you may need to consider your options in trying to supplement your policy with a personal policy. Finally, you could buy your own individual disability insurance policy. This is what I personally do and what I recommend most people consider, especially if your work doesn't offer any or enough coverage. For most people, it makes sense to get a traditional disability insurance policy. However, there are several different types of policies that could be purchased, such as business overhead expense policies, which could pay a business owner's business expenses such as salaries and rent if they became disabled, or a lump sum benefit to pay a business owner's partners for a buy-sell if they became disabled. But for most people, a traditional policy is all they should consider and what I'm going to cover. The downsides of this type of policy are that they are not a guaranteed issue, since you need to qualify based upon your health and income, and they are typically more costly than a group policy offered through an employer. However, the benefits of this type of policy are great in that if you switch jobs, this type of policy is yours and portable, meaning you keep the policy and can continue it as you change employers. Also, you can customize the specifics of your policy and purchase riders on the contract, which can turn on other optional benefits to make your policy stronger. Some of the things you have control over are the elimination period, the benefit payment, and optional riders. When buying a disability insurance policy, you should make sure that the company you will be using offers the correct policy provisions and/or add-on riders that you would want. Some of the most important optional riders that you should be aware of and consider are the cost of living adjustment rider, the future increase option rider, the own occupation rider, and the residual benefit rider. For more information on these riders and any other riders I didn't mention, you should contact the agent who is helping you with your insurance. Now, finally, let's discuss cost. There are many things to consider when it comes to pricing for these policies, and it is critical to purchase a disability policy before you ever need it. I recommend as soon as you start your career, you should consider getting a policy, because now you are in the correct line of work for your policy, and the younger you are, the cheaper the policy will be, since these policies get more expensive the older you are when you purchase one. Also, the potential risk of getting a medical issue that could cause you to get declined by the insurer and not be able to get a policy increases. Therefore, the earlier you get one, the better. If you are older and nearing retirement, then it may be more prudent to consider long-term care insurance over disability insurance, but that would depend on your individual situation. In my opinion, when it comes to life, disability, and long-term care insurance, you need to buy the right amount of lifetime coverage as soon as the time is right in order to ensure that your foundation is stable and you can keep your lifetime insurance costs as low and efficient as possible. Besides buying a policy when you're young, another potential way to reduce your own insurance costs is by applying for coverage with a group of your colleagues. Some insurance companies offer group discounts for a common employment affiliation that doesn't need to be sponsored by the employer. This can oftentimes lead to reduced lifetime disability insurance costs on your own individual policy if you go this route. If you would like to explore the cost and options of getting your own disability insurance, then talk to your trusted disability insurance agent or give us a call. My team and I are independent advisors, so we work with many of the top organizations and don't have the same inherent conflicts of interest that many captive insurance agents are stricken by. This means we strive to get you the best and most affordable product we can, given your situation. My goal is to help more people become affluent through education and asset management. I hope that you find these videos extremely helpful and can use this information to work towards becoming affluent on your own. If you get tired of doing your own research or don't have the time and energy to manage your own strategies and assets, then let my team help. We work with clients all over the United States and can help you virtually so you can work towards becoming affluent from the comfort of your own home or office. To learn more about our services, visit my website at www.nickweberwealth.com.